Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgreen, the founding CEO of Lundgreen's Capital.
This is Sound Economies with Mel and Peter, a weekly East Meets West podcast by Lundgreen's Investor Insights. Join us as we analyze developments in major economies and financial markets globally. Welcome to the show and welcome back to Manila, Peter. It's always nice to have you here.
Thank you, Mel, and it's a big pleasure being here. Always sunshine every time.
Yes, this episode is very special to us, so we'll have a lot more to discuss, a bit looking back and more on looking forward. So let's get started. First, we'll look at major market shakers that shaped the economy in 2025, and these are the ones that we're seeing to continue into 2026. We'll talk more about that. And then, of course, we'll do a look ahead for more major events that we're looking out for the rest of the year and beyond. And as usual, we do our global outlook by economic region as well as the major investment assets that we look at. Peter, let's look at some showstoppers of 2025 that we're seeing to be emerging or continuing as trends into the new year. First, the major story really in financial markets was the artificial intelligence or AI rally. So a lot of major stock markets were driven largely by AI optimism. So we saw that in the US. Korea saw a double increase at the record highs, and it's continuing this so far into the year. Japan as well. But we noticed also that it's not the story as far as Southeast Asian economies or Southeast Asian financial markets are developing. It's not given a boost as much as the rest of the developed world.
There's surely that the AI is a giant competition between US and China. And it's also where we find the true centers of AI R&D development that is still Silicon Valley when we're talking about US. And in particular, Shenzhen, north of Hong Kong, when we talk about China, there's also a bit in Beijing. But it's mainly Shenzhen. But these two giant powers are simply dominating the market, also showing the trend. And there we will see, by mentioning US and China, a couple of regions or areas are actually left out. And it has been obvious to see also in how the stock market has moved. Yeah.
I think some portion of 2025, there has been some discussion coming out of the IMF, which we found quite weird, honestly, in this podcast, that they were warning of a potential AI bubble. I don't think we've seen the case that was true, not anytime soon at least. Demand has been strong for AI development. More and more software developers and complementary services and power supply, construction, data centers are coming. A lot of growth there. And for consumers, we've seen that translate quite to the negative in this portion, wherein chip makers are actually shifting their production to more high-powered memory chips just to keep up with the AI demand versus their usual production for chips for like smartphones, gadgets, appliances. So there's a win and there's a con, as always. And I think we should take that as a sign that there's no slowing down with AI soon, nor is a bubble gonna burst soon in that space.
Surely, as AI in many aspects will simply continue to spread and even with a higher pace. When we look into the as a sort of the AI chip production, and that is a bit where we've seen a sort of a bubble, or we could discuss: is there a bubble? Yes, there is a bubble. Is it big enough to explode or to burst? No. And as you mentioned, we have IMF all of a sudden doing investment advisory. We recommend them to leave that to us. And we listen a lot to what they have to say about the macroeconomic outlook. We really respect them for what they're doing. Still, the headline discussion about AI And also just to comment to sort of the bubble discussion, we have already seen a lot of new manufacturers entering the scene with chips that are significantly cheaper. They might not meet the highest standards among the best AI chips, but it's not necessary either. So it's a lot of things can still work.
It gets the job done. Yeah.
Yeah. So actually, the market is broadening quite a bit, but we're just talking about chips. But what is interesting is also how to deal with the AI chip market is one. It's sort of the one direction, but AI in general is of course means a lot in all sectors, but could, as what we're looking at also at Lundgreen's, is saying, okay, there are affiliated sectors or segments close to AI chip production or sort of close to the heart that might be more interesting. Affiliated, still we prefer sort of B2B segments within AI. We're not so happy for innovations towards consumers. Not that we don't respect them for being fantastic or good. They're just very hard to price. So it's very hard to set a valuation on such a company. But there are other areas that are really interesting still in the B2B area that are close to the what we'll say the center of AI. Yeah. So a lot of things, a lot of opportunities, and will that continue in 2026, Mel? Yes, it will. That's for sure.
You mentioned about direct business-to-business AI provision in terms of goods and services. I think that's what's missing as far as driving stocks in ASEAN for relating to AI. So it missed the boat on the AI rally last year, mainly because it hasn't really developed. The region hasn't really given birth to an equivalent of a Chat GPT or a DeepSeek as far as China is concerned. So more of their services are supplementary or complementary, but not directly into the AI development and machine learning space. So that's what we'd like to see this year.
Yeah, I fully understand, and of course it's tough to be neighbor to China. Yeah, it's such a dominant power within the space. What could happen in ASEAN, Southeast Asia, outside China, is maybe also looking into the software industry. That's again sort of AI related or affiliated segments that will lean towards as a benefit from the AI development, but maybe you would see they look like supply side into software development, benefiting from the AI boost. That could be in certain areas of the ASEAN countries. Honestly, to look at a country like Malaysia, probably the one country being maybe the best candidate here.
Yes.
Of course, we do also favorite the Philippines in many segments, but Malaysia is just still
ahead.
Sort of good position that way, as an example.
Yes. We throw this question to our listeners, to our subscribers. Do you think the AI rally will continue into 2026? Please use the poll feature in this app. Peter, another megatrend that we've been discussing for quite a while. We saw it clearly in 2025 and hints of it spilling over to 2026. It's the rising cost of living issues, more apparent among developed economies against emerging markets. Inflation has been rising again for many major economies that we cover. And it comes at the time when central banks are actually trying to pull interest rates back down just to assist growth and stimulate domestic spending. Though spending is a challenge currently because I think wages have been stagnant for more economies than the rest. And how do we see consumption developing into the new year?
One of the discussions we have internal, you, I, others, about how strong is global consumption.
Yes.
because global consumption has actually been stronger since COVID-19 sort of ended for sure,
Yes.
also during COVID-19 partly. But we are a bit nervous about consumption in some countries now. There are some signals of some areas being squeezed. When we talk about the lower middle class in US, they're squeezed.
Yes.
The middle class in US,
They're okay.
yeah, they might complain a bit, but sort of after all, to give them some comfort, they're better off than they were if you take before the financial crisis, 2008, 2009. So it's not that bad, but the lower middle class is a bit squeezed, and we do see a squeeze here and there. And that is sort of the cost of living discussion we also have had, you and I, where you have raised and said, okay, the cost of living inflation is not a strong issue in, let's say, for example, Southeast Asia,
Yes.
but also in other emerging market countries, where it is an issue in the old economies. And we see it from actually Japan, across Europe, US,
Yes.
and why is that? So it's not a global sort of
Disparity.
inflation squeeze. It is an old economy cost of living squeeze. There could be two reasons to study a bit there. Is it really so that the old economies or the households in the old economies now cannot afford to pay the food prices, but households in emerging economies are still moving so much forward that they can afford to pay the price? This is a mega trend that we are sort of working with it. It's on the board, in our drawing board, sort of on the whiteboard. But we don't know if we could conclude this is actually a trend. As it is so, we don't know. But it would be a disaster for the Western households if that is the case, because you cannot change that within just a year. That is a very structural position to end up in. So that is one thing. But then there is also a cost of living perspective that is interesting in the way we have seen examples. Some years back, elections also in Europe that were, I would call, green. The green mainstream really won many seats. And there was sort of a tendency to tax also normal consumption, also what would influence the price of what you buy in the supermarket as food. And now these new taxation laws, they are surfacing. So it takes time before they're coming through the whole approval process, but the intention was to make it more expensive to consume this kind of food items. And now people are complaining. That is interesting. My impression is that it's not as explicit in the sort of like, let's say here in ASEAN, in Southeast Asia.
I think a big factor as well, separating the old and the emerging markets, is productivity. So it's also likely that wages or disposable incomes are rising much faster in this part of the world because people are productive. A lot of them are in the labor force to begin with, against parts of Europe, we can say that where working hours are shorter, thus productivity is lower. So there's really not much justification to keep wages growing as fast as it used to. We have talked about this once in a while that even after the pandemic, people in some parts of that developed side of the world didn't really go back to their usual 8 to 5 in the office or like their job shifts. And yeah, for some industries, it works well and great as long as you get the job done. But in general, more industries are suggesting that shorter work hours really do mean lesser wage productivity as well. So that could be another explanation. And as long as that trend continues this year, we can expect that it will contribute to this general cost of living woes haunting the old economies, Peter.
Yeah, this is this is a strong house who we actually have. It is what we think will enter sort of a mega trend status with us.
Yes.
And that is hugely interesting because it again moves where the private household purchasing power is and will be and is moving towards.
Peter, perhaps not a trend, but a sure continuing authority in 2026 would be Donald Trump as President of the United States. Of course, we pay attention as it is the world's largest economy. And he has spent a year in office, tariffs left and right, and then walking it back, and then refreshing with an even higher rate and back. How has the world changed after his February tariffs and then eventually the bigger Liberation Day tariffs? I think it has, for one, started a more protectionist, inward looking, local first mentality, which is not necessarily healthy as far as global trade is concerned. Anti immigration sentiment is there as well, which is also hampering the movement of labor. And it's not really the best outcome for economies, but the impact is largely most negative for the US itself.
Yeah. Let's say, Mel, has it been an interesting period? Probably yes.
Definitely.
It is so unusual, honestly, that we would say it's sort of a new situation, but he has not changed a lot. Yeah, has been a lot of noise. We like each and every day there's so many lines coming out from the White House throughout sort of within 24 hours. Mm-hmm. It confuses a lot of people because there's a tendency to say it's a news that's coming out all the time, but it's not. As people are paying way too much attention to what he's saying, is my opinion. It's just noise, most of it. And you say, yeah, but in between there is a line that is really important and that matters. And we say, yes, there is, but still, the important messages from Trump and what has made a change are actually few, so to say, and they are also relatively easy to recognize when they come. So the rest of whatever is coming out from from Trump and from the White House is predominantly noise, but of course the tariff war is more than just noise, and it's pretty serious actually. Will that continue? Probably yes, but so far it has generated what we sort of describe again as a sort of a value destruction more than anything else. And how long can value destruction continue? It can continue as long as it doesn't really hurt the economy, because in November there's a midterm election. Yeah.
Yes.
And that would be interesting. And right now, as we talked about before, at least the lower middle income households are squeezed. It's not necessarily so that each and every Republican is angry at Trump. The MAGA movement is actually still there, and it's not running away from Trump. But it could be overall enough for Trump to be squeezed in the polls, and he needs to do something about it. Do we expect some sort of fiscal sort of tactic moves? Yeah.
Subsidies, maybe?
Yeah. We would expect something to happen to cheer the economy up, and also to cheer voters ahead of
Elections.
This is what we would expect. It also means that as a Trump will predominantly continue to act as he does.
What we saw emerging from the Trump tariffs is a US versus the world scenario where the rest of the world is navigating new trade deals, new agreements. We have China moving to Latin America, closer ties. European Union striking new deals with like India, the UK. even China, Canada, although at a lesser degree. And it now shows the world that, hey, yes, the US accounts for 1/4 of global GDP, but then that's a bigger 75% that can work together and kind of offset those flows that have been rechanneled otherwise. And also, as a result, there has been capital rebalancing away from the US and aggressively into emerging markets. We've seen some countries benefiting more than the rest. So for Southeast Asia, I think we mentioned this earlier, it has been like Malaysia, uh, nearby India as well. Brazil has been getting the action. It's been lifting their stock index in the past few months. Why are these markets more favored, I guess, is the question.
This is natural for trade. It moves a bit like water. Yeah? It will always move forward or another direction, simply. If Trump doesn't want to be part of the playground anymore, then you will find other friends. Yeah, this is basically what happens. And it's interesting to observe who's losing out. And it's predominantly U.S. companies. Yeah?
Yes.
And then we turn back to the sort of value destruction sort of conversation. What is Trump actually creating for U.S.? Yeah, it's hard to see there's anything good. Yeah. Despite that Wall Street is hanging in.
You have described that the US has shot itself in the foot when
Yeah.
it elected Trump and supported all these anti-trade, seemingly anti-global trade policies. Now we'll see if they'll shoot themselves in the other foot this time in November.
That will be interesting. Yes, we will. As mentioned, probably some initiatives, fiscal initiatives to cheer up the private consumers, but again, that will make the bond market nervous. It's also why we are calling for a lower US dollar in 2026, following a pretty steep drop in 2025, and that is unusual that we will see two negative US dollar years
In one.
in one go. Yeah, but this is linked a bit to nervousness about the fiscal policy actually to lose and too much debt. Yeah.
So the value destruction is apparent and will likely
it
continue.
is, yeah, for sure.
Lundgreen's Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more. Peter, a lot of what we discussed earlier is about really the movement of investments, of flows away from US and to areas where it's perceived to be better in terms of growth potential. Which regions are we talking about here?
Yeah, obviously, there have been a flow towards emerging markets, in particular to this region where we sit as in the middle of the region where we are right now,
Yes.
to Southeast Asia. That's obvious, and it's basically as we have been arguing for this move and focus actually since I would say end of 2020 to October 2022. So for us, it's a longer trend, but that has been one move. And there has also been a move from US into to Europe actually, and we can see that as well. More interesting, we see some of the new developing sort of trends is a bit sort of it's still early stage, but we can find it when we speak with companies, and that is sort of the very early stage for their investment flows to say, okay, so where's the focus heading? And there is actually a sizable move towards South America, Latin America, and we see Africa more on the radar screen now, and that is interesting, and I could easily see more of that coming as well. Some of it is what we would call frontier countries and not emerging market countries, but still extremely interesting.
It's only a matter of time when the domestic economies in these parts of the world get their act together, at least improve slowly but surely. And of course, there's no way to go but up for these markets.
Sure. And should we talk a bit about diversification? Now, this is sort of the geographical move.
Yes.
We have recommended for almost 1.5 years ago, we took down our overweight US, and that was a bit due to the outlook for Trump, simply value destruction. It was so obvious. Recommending going from listed markets into more non-listed investments, in particular in Europe, even Germany, where there are still really good opportunities to invest into companies that are non-listed, and there's of course also funds, alternative funds that are investing into these areas where investors can join. We run some of them ourselves as well, yeah. So this is another diversification that we recommend to look into. There's a good growth potential actually.
In an era where we expect even higher volatility, we've seen that manifest even in commodities. Like
Yeah.
very recently, gold and silver prices were dropping in a large way when it should ideally be the safe haven for most investors.
Yeah. Yeah, gold is of course seen as sort of yeah, kind of safe haven, but the latest movements drops. We saw silver losing 30% within
A day.
almost a day. Yeah. That is extremely dramatic and represented as a really a individual bubble for that commodity, enormous speculative bubble. But we do, yes, continue to expect volatility in the markets. We have argued since, in particular Q4 last year, about higher volatility coming to the markets. We have seen it. It has arrived. Should we be afraid of it? No, not at all. Should it even lead us to sell out of and sell all stocks? No, it's not. It's more a work condition. We do not see that the market are tilting or simply dropping significant. There will be more opportunities. We see the bigger swings in AI, in the tech stocks. Yes, that will lead to higher volatility. We will also see more volatility in the currency market. So all in all, there's enough to take care about for investors. But again, we have seen it before, and we lived with it, and it's basically what we are paid for as managers. Yeah.
Well, in our line of work, we've always talked about outlooks in terms of sunshine and clouds.
Yeah.
How's the picture looking like for this time in 2026?
We still argue, if we take the global perspective, it is we are for overweight risk, despite the volatility, higher volatility we talk about. And when we talk about different trends, households bit more on a squeeze, there's still an outnumbering of opportunities, upside opportunities, if we maneuver in the financial market. It is not as easy as it was for a couple of years ago. You just put a dollar somewhere and it would be more worse after 6 and 9 months. It is not as easy right now, but if we work a bit around the challenges, there are truckloads of opportunities, and that is why we have the overweight of risk still, meaning we see more sunshine than clouds. And Mel, now I can ask you a bit back. So where do we see the Asian region?
Well, there are plenty of opportunities still in Southeast Asia and emerging Asia, to include China. Growth has moderated somewhat as far as the Chinese economy is concerned, but there is no doubt that it can easily perk up or return to the high growth trajectory once it resolves its own. I think the property crisis is still affecting that sentiment domestically, but there is room. Manufacturing companies in China are quick and agile to find new platforms, new products to sustain growth in or to expand globally, and it is finding new markets. We saw that last year, and that would open up more opportunities for the region. And as far as ASEAN is concerned, there is some growth continuing. We still see that Southeast Asia will be the world's growth leader over the next decade or so. And that is providing this very high confidence level towards this part of the world.
Agree. So we see that as the most opportune. Other emerging markets as well. Overweight risk, go for the sunshine. This is still our outlook also for sort of general 2026. Right now, it can change at any time, but this is how we see it as we record.
There is an abundance of opportunities, Peter. You're right. And it's only a matter of looking at the right direction, and we can help you in that arena. So
Absolutely.
that's what we do. Thank you to our audience for tuning in, and thank you, Peter, for sharing your insights with us.
Pleasure being here together with you in a real studio this time, so it's good.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Lundgreen's Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts.